2025 is going to be a year of new opportunities and market shifts, but which ETFs are worth your hard-earned cash? Today, I'm looking into 5 top-performing ETFs that many analysts believe could skyrocket your portfolio. If you want insights on navigating the highs, lows, and everything in between, stick around and keep watching. Welcome back to the channel. Today, I'm giving you insight on the best ETFs to consider in 2025 based on potential growth, stability, and market trends. Whether you're just starting your investment journey or fine-tuning your portfolio, I'll help you decide if these top ETFs are worth it. Let's start with one of the most popular picks, the Vanguard Total Stock Market ETF, VTI. If you're looking for full market exposure to the U.S. stock market, VTI is as diversified as it gets, covering everything from large cap to small cap stocks in every industry. This ETF has around 4,000 stocks, which means it includes virtually every publicly traded company in the United States. Here are the pros. Strong historical performance. Over the past 10 years, VTI has delivered annual returns averaging around 12%. This is great if you are a growth-focused investor. Then there is diverse U.S. exposure. VTI covers nearly every publicly traded U.S. company, which means your investments are spread across all sectors and industries. And it comes with a low expense ratio of 0.03%, which means you are keeping more of your money invested. But there are some cons. Full market exposure can bring ups and downs, as you are exposed to both stable and high-risk stocks. And then there is limited income. If you are looking for strong dividend yield, VTI might not deliver as it primarily targets growth over income. The bottom line, if you're looking for a steady income stream, this might not be the ideal choice. But for growth-focused investors, VTI is a fantastic option for broad, low-cost U.S. exposure. Up next, we have a dividend powerhouse, the Schwab U.S. Dividend ETF, SCHD. This ETF has attracted massive interest for its combination of high yields and growth potential, and for good reason. Here are the pros. High dividend yields. SCHD has a strong history of delivering steady dividend, currently yielding around 3.4%, which is well above the S&P 500. You can see why it's an attractive option for income-focused investors. Quality stock selection. SCHD uses a disciplined screening process, selecting companies with strong financials, consistent earnings growth, and high dividend payout, which adds a layer of reliability. And like other Schwab funds, SCHD has a low expense ratio of 0.06%, so more of your investment goes towards growth. But there are some drawbacks. SCHD leans heavily into sectors like financials, healthcare, and consumer staples, which limits its diversification. And for those of you seeking high growth opportunities, SCHD's focus on dividend-paying stocks may not provide as much growth as other tech-heavy funds. So is SCHD worth it? If you're aiming to create a reliable income stream without sacrificing growth, SCHD is definitely a fund to consider in 2025. Moving on to something a bit more innovative, the Technology Select Sector SPDR Fund with ticker symbol SLK. SLK is a sector-focused ETF that targets technology companies within the S&P 500. What this means is that it's full of industry giants and innovators. The pros? XLK's holdings include major tech players like Apple, Broadcom, Microsoft, and Nvidia, companies that have seen impressive growth over the past few years. This ETF is well suited for those of you who want exposure to the tech industry's rapid pace of innovation. Then there is reliable performance. This ETF has shown strong performance compared to broad market indices, averaging annual return around 17% over the past decade. XLK is a great option for growth-oriented investors. And with an expense ratio of just 0.10%, XLK offers a cost-effective way to tap into the tech sector without the fees that often come with actively managed funds. But there are some cons. Sector concentration risks. Because XLK focuses solely on tech, it lacks diversification. This makes it vulnerable to tech-specific downturns. This concentration can make it more volatile than a broad market ETF. There is limited dividend income. Tech companies generally reinvest earnings rather than prioritize dividends. So if you're looking for yield, XLK's income may not be as strong as some other sector funds. And then there is susceptibility to market cycles. Technology stocks tend to be more sensitive to economic conditions and interest rate changes, which can amplify the ETF's ups and downs. The bottom line, for those wanting exposure to cutting-edge tech within the S&P 500, XLK provides a streamlined, affordable way to invest in top tech companies, but be mindful of the sector-specific risks. Now let's talk about a fund that opens the door to international growth, the iShares MSCI Emerging Market ETF, EEM. This ETF gives you access to markets like China, India, Brazil, and Taiwan, which are expected to grow significantly faster than developed economies. So let me give you the pros. Exposure to growing markets. Emerging markets offer significant growth potential and are expected to outpace developed economies. Sector diversification. This ETF invests in large and mid-sized companies in emerging markets and provides a solid mix of tech, financial, and consumer stock, with top holdings like Alibaba and Taiwan Semiconductor. This makes it less reliant on any one sector. It offers diversification that most US-focused ETFs can't. But you must also consider the cons. Political and economic risks. Emerging markets are more prone to political instability and regulatory changes, which can lead to volatility. Currency risk is another con. Since these investments are outside the US, currency fluctuation can impact returns. And the fund also have a higher expense ratio. With an expense ratio of 0.68%, EEM's fees are above average for ETFs, which could impact long-term returns. The bottom line is this: if you're looking to add some global exposure to your portfolio, the iShares MSCI Emerging Markets ETF could be a smart choice, but it comes with unique risks. And finally, we have a tech giant favorite, the Invesco QQQ, also known simply as the Qs. This ETF tracks the NASDAQ 100, which includes 100 of the largest non-financial companies listed on the NASDAQ. You will get an exposure to some of the biggest names in tech. The pros: consistent growth. Thanks to holdings in Apple, Amazon, Microsoft, and other tech giants, QQQ has consistently outperformed many broad market indices. Exposure to leading sectors. The Qs provide access to some of the fastest growing sectors in tech, including semiconductors and software. But there are some cons you must contend with. 1. Tech sector volatility. When the tech sector faces headwinds, QQQ feels the impact due to its sector concentration. Limited diversification. As with other tech-heavy ETFs, this Invesco fund has less exposure to other sectors like energy and financials, meaning it may not perform as well during periods when tech is under pressure. And then there is a higher expense ratio. The Q's expense ratio of 0.2% is higher than Vanguard's VTI, though many investors feel the potential gains outweigh the costs. The bottom line? Keep in mind that tech stocks are more volatile, but if your portfolio is focused on growth, you must consider Invesco QQQ. Here are the top 5 ETFs we've covered and what makes them stand out. So are these ETFs worth it? Absolutely, if they fit your financial goals and investment style. VTI is a low-cost way to diversify across the US market. SCHD combines income with growth. XLK is a simple and affordable way to invest in top tech companies. EEM brings emerging markets to your portfolio, and the Qs offers reliable tech exposure. Depending on your investment horizon and risk tolerance, any of these ETFs could be a valuable addition to your portfolio. If you found this breakdown helpful, please hit the like button, and if you haven't already, subscribe for more tips and insight. Comment below which ETF caught your attention and check out my video on the 5 must-have ETFs. Until next time, stay financially savvy. I'll see you in the next one.